everybody, and welcome back to another True Potential Do More with Your Money podcast. It's episode 137 this week, and as ever, we're joined by an expert panel. So let's meet them. I've got to my left George Bell. Hi, George.
Good morning.
Good to see you. Paul Durrance back with us,
Morning.
and Neil Rayner back
Morning.
fresh from his holidays as well.
Morning.
Last time I spoke to you on the podcast, Neil, you were just about to jet off.
I am, yeah. Had a really nice time, thank you.
Good. Well, it's nice that you've jetted back, especially for the Do More with Your Money podcast. Now, today we're talking about diversity. Neil, before you get excited, I'm not talking about that band that won Britain's Got Talent. It's not that type of podcast. I'm talking about diversification, diversity in your portfolio, which is, of course, what we do here at True Potential. So I've got the experts from our investment management team, George and Paul, who'll tell us all about what that means, how it's meant to work, how it does work, and what it's doing for you. And Neil, of course, from his client perspective, will give us the feedback from what it means to clients and their advisors. But first, just to open up then, diversification. We talk about advanced diversification at True Potential. Paul, a nice easy one for you to start with. What does that mean?
So diversification is a risk management strategy, and it's combining different asset classes that behave differently and that are uncorrelated to one another to reduce the overall level of risk. So the client experience, by being diversified, a smoother journey in terms of their investment portfolios, and that is not you can still maintain above average higher return over time. So you can actually achieve what they call a higher risk adjusted return, so getting more return but lowering your risk.
And in simple terms, is diversification, is that the opposite of all eggs in one basket? So if I was going to go and just say buy, a few £1,000s worth of one share, then I'm that's it. I'm backing that thing, or I'm not. Diversification is the complete opposite of that. You're spreading your investment around, and
so if you were to buy one share, one stock, then you risk potentially losing all your investments. By spreading it across different asset classes, you avoid that risk.
Yeah. And why? Give us an example in terms of what that might mean. If I say invest in the True Potential portfolio, what does that mean? How am I getting that diversification?
Yeah, so the True Potential portfolio is essentially the side which I'm on. We are building a portfolio made up of a selection of investment fund managers. Mm-hmm. So Paul's fund, Growth Aligned, is one of those managers. In essence, what we're doing is we're bringing together a collection of different investment instruments. So different types of company bonds, different types of government bonds, different types of stocks and shares. We're also looking at precious metals, currencies, a whole manner of different aspects to spread out the overall risk, but also give you opportunities in that toolbox as well. Yeah. So we're diversified by the type of instrument, the region of the instrument, the currency aspect as well. We take it one step further as well, and we say that, okay, individual managers, they tend to have positioning, they'll have a longer term view, and they'll position tactically around that through time. But it may not be the environment for that specific manager at any point in time. So why hold clients at the mercy of one single fund manager approach? We provide a blend of different fund manager styles. So you've got diversification at multiple different levels there for clients.
Yes. So I was going to say, if I to give you an example, if I, I don't know, let's pick something which just tracked, say, the FTSE or tracked an index. Obviously, there's 100 different companies in there. Am I not getting a level of diversification just by doing that? How do you go beyond even that?
You are getting some diversification because the FTSE 100 has 100 companies in it, and you're getting exposure to different sectors, utilities, financials, materials. But the FTSE 100 will be influenced by different factors or different dynamics. So very much there's a degree of correlation to how the pound performs. So if the pound weakens, the FTSE 100 typically does better, as you've seen this year. But we look beyond that and want to be exposed to different asset classes that be influenced by different factors, whether that be inflation, whether that be currencies, whether that be interest rates.
And you mentioned different managers and styles. I mean, let's just go back a sec for clients and advisors who are perhaps new to the podcast or even new say to True Potential. What do you mean by different managers and styles? I mean, we talked about that sort of no diversification, just buying say one asset or one asset class. We've then talked about an index, which gives you a little bit of that, but we are so much more in terms of, as you say, styles and geographies and all the rest of it. But just come back a sec. Tell us about what you mean by that.
So to take some live examples of managers which we have in our portfolios at this point in time, you've got managers who are more traditional, what you call a value manager. They're looking at assets, instruments which are, they believe, priced below the price that they should be at. So that's more of a valuation approach. So famous examples of managers with that type of approach include Warren Buffett, one of the most famous examples out there. Another type of manager might look at newer companies or faster growing companies where they expect that the valuation will continue to increase, but they will start to see rapid earnings growth come through. So examples we've discussed over the last number of years have been technology style companies in that. And the delivery of those different styles has been very different over the past number of years. You know, those technology style companies performed better during the pandemic when you had industries and manufacturing in lockdown. But as we came out of the pandemic, as economies were reopening, that valuation style, so the style which is more sensitive to industry, manufacturing, the underlying health of the economy started to recover. So that was an example in 2020. Through the course of this year, we've also been bringing in diversification in the sense we've got some managers who have more attraction towards bonds and some managers who've got lower attraction towards bonds. We've got managers who've had a bigger desire to hold more sterling, and we've got managers who've had a bigger desire to hold more of the US dollar, as an example. So the delivery of those managers would have been very different in all of those different environments. It's our job to say, okay, well, for a client, what's the best, what's our outlook, and which series of managers do we want to have the biggest tilt towards?
Well, that's bringing Neil in from a client perspective. I mean, what is it, in your experience of talking to advisors who are talking themselves to hundreds and hundreds of different clients, and obviously through your role directly with clients as well, what is it that clients are actually looking for? What do they want from when they're investing with, say, True Potential? What is it that they're after?
Well, I think obviously, you know, when you invest from a client point of view, you're looking for predominantly some sort of return. When the markets do get a bit choppy and when the markets do get a bit volatile, we'll get calls from clients, you know, because they will be looking at the portfolios. The great thing is about accessing the valuation is you can see it in real-time value straight away on your mobile phone or your iPad. And the questions that we typically get are things like, tell me about my portfolio. You know, as we know, we have different levels of risk for each different client. Risk is very personal. And a lot of the questions that we do get when clients call in are, can I have a look at the breakdown of my portfolio? You know, how much does it hold in maybe UK equities? How much does it hold in US equities? And it's quite an interesting conversation because a lot of clients will know that they're in a particular portfolio, but what they will not obviously understand is the makeup of that portfolio. And the advisors talk with the clients, you know, regarding the risk. So as an example, defensive portfolio might hold about 22% equities, whereas your aggressive portfolio will hold about 90% equities.
Right.
So there's a big difference, but risk is very personal. And the questions that we get coming in are, especially in volatile times, are, you know, look at the performance, but it's also as well a chat about medium to long-term goals. You know, you might have a person who is invested in the portfolios in their 30s and have a 30-year goal. We have to explain the difference about, you know, the long-term outlook.
Yeah, I mean, you mentioned at the start there that when you said that what clients are probably looking for, what they surely are looking for, is for their portfolio, their investment to grow. How does diversification and the advanced level of diversification that we do help that? How does it help achieve that, Paul?
Diversification is allowing you the opportunity to be exposed to many different assets. You know, we're not just investing in equities, we're not just investing in bonds, we combine them, but we can also look elsewhere. And by diversifying and keeping risks lower than just investing in one individual asset class, we can afford to take on new opportunities and look at elsewhere. But you need the expertise, George and the team, to really understand the characteristics of these asset classes, how they are interacting with one another, and to have the time to look at the opportunities as well and where we're heading.
It's probably worth just touching on, you know, those characteristics year to date and what those developments have been. And Paul mentioned the term correlation, which is the relationship of assets over time. And this year to date has been different in the sense that we've seen interest rates rising, and therefore bond yields have been rising as a result. and that's been a challenge for the return of bonds. It's also been a challenge for the return of equities as well. So traditionally, where you've seen a low correlation between an equity and a bond, this year that correlation is moved higher. So in other words, the challenges have been felt on both sides, which I think is the reality of the situation which we've got here.
Yeah, I think it's an important point, which you said before about putting all your eggs in one basket, and we do stress that with clients, about the diversification and the importance of doing so. As Paul and George have just been talking about, it's really important that we have that diversification in place with the portfolios that TPI manage, really to minimise the volatility that is going on, certainly at this time. And clients, when they do call in, they are assured by that. They are, they are confident. And like I said before, you might have a short-term goal. You might have had a medium. You might have had a long-term goal. You might be approaching retirement. And it's now more beneficial to look at maybe your portfolio and see if you can maybe go down a risk, or if you feel comfortable and you're a little bit younger, you want to go up typically. But it's having that conversation
with your advisor or ringing us up
here. With your advisor.
Yeah. But I think it also comes back to the way in which we invest. So we're forward looking in everything which we do on the portfolios, but also within the growth aligned fund, and we've known that interest rates weren't going to stay at zero levels for forever. They had to come back up. So that provides sensitivities for assets there, such as bonds. So we've been preparing for this in the sense of the way in we've been positioning within our bond portfolios, moderating the overall exposure which we have towards risk assets. We've got higher cash levels than what we came into the year with. So what does that do? It means that forward looking, we've been preparing and diversifying our portfolio in that sense away from those assets which we did view as more sensitive. But it's also putting us in a position to exploit the opportunities that you have by being an active fund manager and having that broad toolbox of instruments to use, because markets have discounted year to date given the pressures which we've seen. From a valuation perspective, and valuation is really important for a long-term investor. The long-term return will in many ways be commensurate of what you've paid for it in the first place. You're buying those assets at a better valuation at this point in time. So yes, we can talk about diversification in the sense of managing risk, volatility and drawdown, but also in the sense of opportunity set as well.
And I think to opportunity, as you said, coming into the year and throughout the year, the managers have had a bit more cash than they typically would, but when you see the valuations come down, that's when they start to deploy the cash.
Valuations coming down, we're just saying assets cheapening up.
Getting the assets at a cheaper price. People will be familiar with the term sort of multi-asset portfolio, so people might be aware of that. Clients might have read about that. And so, for example, if you bought, correct me if I'm wrong, George, but if you're buying a multi-asset portfolio, you might get a bit of equities, a bit of bonds, so on and so forth. But where even the level of diversification that you guys are doing is a level even above that, because you might have, if I'm right, you've got a bit of UBS, a bit of Goldman Sachs, a bit of Pictet, whoever it might be. How does that give you that extra even level? What you talked about different manager styles and things like this. I mean, it's multi-asset, but it's even more diversification through almost lots of multi-asset portfolios rather than even just one with one style. Is that right?
Yeah, exactly. So if we take one particular manager, and we won't name them, but let's take one of our fund managers. They will be multi-asset in their nature. So what that means is they're investing in a range of different instruments, equities of different type, different style companies in different
geographies.
Different geographies. Same within bonds, they'll hold different currencies. They may hold assets like gold in there as well. But they'll have one single way of investing. They'll have a view. They'll be positioning for maybe a longer term view, and they'll stick with that to all intents and purposes. They will be active around that. If there is situations which evolve, they will respond to that. But generally, they've got a style and they're implementing that style. Challenge is that it may not be the right style for the environment which we're in. So why would we hold clients at the mercy of one single investment style? What we do is we work with a range of global investment professionals. We appoint them selectively for the style which they have, and we bring these into a portfolio construct, and we say, okay, yes, we want multi-asset investment managers, but we also want choice as to which of those managers we work with at any point in time. So our decisions as a portfolio manager are around the weighting which we place on each of those managers, and that's what evolves. The challenge is, it's not a challenge in this sense, but in terms of the display of this, whilst not all portfolios, whilst we won't change the weighting to those managers every month and rotate them and turn them on their head, the point is each of those managers are active, they're multi-asset, so they are evolving the funds through the course of a month, through the course of a year, responding to those opportunities and risks. So we've got to have that absolute awareness of what they're doing and how that feeds into what we're doing.
And the benefit to the client being that if, to use your example, if fund manager A is, say, heavy on US equities and that's not performing great in the volatile market, you might have fund manager B who perhaps is say more focused on emerging markets or things like this, or Asia or something, and that maybe offsets a little bit of the. Is that basically it? Trying to just sort of offset?
A little bit, yeah. It's different managers, different styles, and you're allocating a bit more tactically and just smoothing the ride in terms of volatility.
Because there is perhaps a misconception. You tell me if you think it is a misconception that diversification is the great insulator against any kind of volatility. But it doesn't work like that, does it?
Yeah.
It maybe means that it performs better in a more volatile market. Would that be your take? It's not there's not a guarantee of anything, is it?
Yeah, it just helps you mitigate those pockets of extreme volatility. So, for example, extreme volatility, where have we seen it in recent weeks? The UK gilt market, and it's been discussed in most of the major press. And what does it mean for us? Well, if our portfolio bond allocation was entirely made up of UK gilts, that would have been a very, very difficult environment for an investor. It's not. It's around 4% of our balanced portfolio. So the diversification is all about saying, okay, well, the different asset classes, the risks that they're exposed to, and the opportunities that they're exposed to, how can we diversify that without costing from an opportunity return perspective?
How often do you quiz the fund managers that you mentioned before? I mean, are you on the phone to them every day, or is it not quite like that?
We've just came out of a formal meeting, which is a monthly series meeting, full team involved, where we do challenge, for example, Paul's fund, Growth Aligned, around the delivery of their performance, the level of risk they're taking, their investment views, and how they're implementing that view. So we'll have that conversation with Growth Aligned. We'll have that with every other manager on a monthly basis. Realistically, if we take our managers, and you mentioned a number of the names there, Peter, we are one of their biggest institutional clients here in the UK, so we're incredibly important. So if we need to speak to the decision taker, we just pick up the phone at any point in time. So we've got a great relationship with the manager. In terms of additional layers of oversight, we've got an independent investment committee who are in place to oversee all of our managers, hold them to account in terms of decisions they're taking, delivery of performance, level of risk they're taking. They also hold us to that accountability as well. So every 2 months, myself and the team will present in terms of what we've been doing, how we're performing, the level of risk we're taking. So there's challenge on all sides, but so there should be.
I mean, George has just kind of explained what I was going to say next, which is, this is the reasons why clients, you can't do this yourself. I mean, some people might fancy themselves as a bit of a stock picker, but you couldn't get that level of expertise and diversification, and just the no one can pick up the phone to the top guy, the top fund manager, but we can.
Yeah, and I mean, we have a close relationship, obviously, because of the nature of the group with TPI. So, we constantly get updates from TPI, True Potential Investments, with regards to the portfolios and major themes that are coming out on a daily basis. We can then relay that back to clients, any concerns that they have. We have some extremely savvy clients who are, well versed in investment strategies. So as long as we can deliver that communication back to the client, then we're doing our job from that point of view.
Yeah. I mean, is this from an advisor point of view? We know there's a lot of volatility in the markets globally, and there has been, all year really. Is it hard for an advisor to go and to sort of explain this stuff to their clients, or does these kind of explanations and advanced diversification, does that make that conversation easier?
Oh, it makes it easier, because what you're doing is you're educating the client to a certain degree as to how the portfolios work. The diversification, which is a really key theme. When people look at the underlying asset allocation of it and think, oh, okay, and then you relate it to a couple of things that maybe you see in the media, see on TV, and they go, okay. And we've had quite heavy documentation over the last couple of weeks on the leadership in from a prime ministerial point of view, and the impact that that's having from a budget point of view, and clients can relate to it. But yeah, it's a conversation that we can quite easily have, and like I said, we get update information from True Potential Investments on a daily basis, so we can relay that back to the clients.
We've mentioned growth aligned a couple of times now.
Yep.
For clients who perhaps aren't familiar with that, don't know what it is. Tell us. Here's your big sell, Paul. What?
Sell it. 30 seconds.
Sell me the growth aligned
elevator pitch. Yeah.
Right, are you ready? So it's an in-house multi-asset fund range. So we have 5 funds: defensive, cautious, balanced, growth, and aggressive. We're multi-asset, so we're investing in bonds, equities, alternative assets, spread geographically. So we're global in nature, exposed to different currencies, and the way we manage the portfolios is very much macro driven, and we have an in-house process using Chris and George and the True Potential portfolio team to feed into this process to help think about where we're heading, what's our views on inflation, what's our views on interest rates, economic growth, and then use our toolkit to help position for that. But we can go in terms of what we're investing in. We're not investing in individual stocks, so we're not buying Apple, we're not buying Facebook, we're buying funds. So typically index funds, so FTSE 100 or the S&P 500, but we can add in active managers that are not within the True Potential suite and bring them in as well, so we can go whole of market.
And the growth aligned bit being if the fund performs, or if it doesn't perform, that there's a for the client's perspective, it's aligned to their own ambitions as well.
Yeah, exactly. So if we perform well, they pay a bit more, and if we don't perform, they don't pay that.
Okay, so we're aligned with the client's skin in the game, you might say.
Exactly.
George, tell us in terms of the markets, maybe in the last week or so, or even the last fortnight, however you want to sort of whatever time frame you want to pick. I mean, how are markets globally right now, would you say?
So I suppose what we've came off the back of in September is a huge amount of volatility within the bond market. So for context, year to date, we all know asset markets have been challenged, bond markets have been challenged, global stocks and shares have been challenged. Very few assets out there actually in positive territory apart from the US dollar, some energy companies, and some alternative products. So we've been using alternative products within our portfolios, but that's the reality of the backdrop here. Just to be fair, what we've seen since the beginning of October is a bit of a recovery in terms of stock markets in sterling terms. So coming off the back of that volatility, bit more ease in terms of what is the approach which central banks are taking in their pathway of raising interest rates. The market in terms of the UK is almost back to where it was before the mini budget used carefully with no OBR study behind it, but in terms of where it was. So in essence, coming off a month in September of a lot of volatility, so far this month things slightly calmer.
And I'm going to put you on the spot now, George. You've set that up very nicely for me, a nice easy one for me to just tap in here. How have our portfolios performed then against what is a pretty volatile and turbulent environment right now, right?
Yeah, I mean, so the True Potential portfolios will recover in that sense with that improvement in the equity market. But to give you some context for what we've seen year to date, you've seen global stocks and shares in local terms down around 20%, global sovereign bonds down around 25%. The drawdown of our portfolios is been around half that. So diversification in action. How have we achieved that? By, as we say, we've had a lower sensitivity to certain aspects of the bond market. We've had a lower exposure to overall stocks and shares than what we came into the year with. We've used alternative instruments, and I appreciate that may not be a common phrase for all clients, but essentially an alternative gives us flexibility.
Give us an example of a couple of alternatives. What that means?
A couple of examples of alternatives and growth aligned have contributed well to the portfolios through the use of these type of strategies. Essentially, when you take a market position, you can go long, so you can buy a position with the expectation the price will rise. if you have a feeling that there's going to be pressure on the price, so you see a negative price, you can also take what you call a short view. So some of these strategies have been able to go short bonds, short equities, and even long areas such as commodities when we've seen a rise in oil and natural gas prices. So those type of strategies have actually been able to generate a positive return. In addition to that, having different exposures to currencies as well, when we've seen sterling weakness, has allowed us to generate a return outcome which has been better than those local market indices, which year to date have been a challenge, no getting away from that.
Yeah.
But the diversified approach which we take has helped mitigate some of the challenges of that. And as I say, back to the valuation point, wide toolbox of instruments, active managers with more cash poised for these opportunities. I believe that, you know, that word opportunity is not one to be erased.
Yeah.
Takes us nicely to a question we've had in from one of our clients, which is, how has diversification protected my investments against these wild swings in the markets? And I think you touched on it there. If markets, depending on what you're looking at and when, but 20% down, the portfolios are nowhere near that. They haven't had that drop.
Yep.
So they've protected against that level of drop that you would have had had you just picked an index or tried to go it alone. So I mean, that is the nub of it, isn't it?
Yeah, absolutely. And unfortunately, you haven't had the protection from the bond market that you historically would have. And because over the last 20 years, returns for bonds have been exceptionally, interest rates have got so low, and when you go into an inflationary environment and they have to push through interest rates, you get negative returns from bonds, but also equities. So that's why, if we look back at podcasts going back last year, the year before, you'll have heard from Chris and George talking about the importance of alternatives, why our managers, Goldman Sachs and etc., have been allocating more to alternatives, because that's a way to actually generate a positive return, even when bonds are falling and equities are falling. So again, it goes down to being exposed to different asset classes that interact differently to give you those diversification benefits, but still allow you to outperform.
Yeah. I mean, have you ever known the level of volatility we've got right now, where you can be up a few percent one day, down a few percent the next, and back up again? And it seems to be just almost like a daily swing at the moment versus maybe what you would have seen over a few months, which you're getting that every day now. Is that correct? Is that your feeling?
I think the difference is now is, you go back to the COVID time when that was just kicking off, March 2020, volatility was exceptional. The level of volatility now has been exceptional, but it's the duration of that level of volatility that's different this time around. You'd have to go back, I mean, before we started, 2008, before that, early 90s when you had inflation problems, and then the 70s, 80s as well. So
and then the diversification smoothens out that.
Exactly, smoothing that journey for the client, but keeping them invested. We've seen, this week why it's important to remain invested and try not to time markets, because US stock market was down over 9% last month in September. The first 2 days of October, you would have clawed back half of those returns. It's just exceptional volatility, very dangerous to trade.
I mean, it reminds me of somebody, say, flying back from a holiday. I mean, it could have been, I don't know, Greece or somewhere, flying back into, Newcastle Airport, and all you really want is a nice smooth flight. What you definitely don't want is any big turbulence over Germany or France, or coming into land and it's all going.
That's right.
Do you know anybody who's had that kind of experience lately?
Yeah. Thursday morning, So when the wings are virtually touching the runway on the other side, or somebody's got their drone out over Newcastle.
Yes,
which is quite interesting.
Yeah, so have a nice tan. You looked a bit green on Thursday, apparently.
I was very
after
green,
that journey back. But that's
green.
what if you're trying to pick an analogy, perhaps a daft one. You don't want that kind of turbulence up and down. You want a nice smooth flight home, and that's what we're trying to create. You were going to say, George?
I was just going to say, in terms of turbulence, what was our expectation coming into the year? Interest rates were going to be moving up, but there's been other events as well. The invasion of Ukraine, European elections, Brazilian elections, the way in which central banks have communicated their policy pathway, and the way in which they view inflation. All of these things spark
China lockdowns.
China lockdown, the continuation of that, zero COVID remaining in place. All of these aspects, drive attention and can drive volatility. But again, it comes back to why do you diversify your portfolio? Because where was the big flare up in volatility through the course of last month, gilt markets. So hence we've got a diversification in terms of our approach there.
Yeah, and I think we've seen volatility from maybe December last year, January, and the reiteration to clients will be, what is your long term, what is your medium goal? Like Paul said before, 2008 and the 90s as well. These are all areas of concern that we've seen in the past. This is probably a little bit of a concern at this moment in time, but when we talk about the diversification and the work that True Potential Investments do, that's really calming to clients because they can understand how that relates to keeping invested, which is the main important thing.
Yeah, keeping your eye on the long-term prize.
Yes.
Which is why you invested in the first place.
Yes.
And not getting too worried or bogged down in the daily churn. That's your job to worry about that, and we make sure they do worry about it, by the way. So don't we keep them on their toes. Another question is, looking ahead, and I'm going to ask you to look into your crystal ball, or our client who sent the question in is going to ask you to look into your crystal ball. What are you, in the conversations you're having with your fund managers and your manager partners, what are you particularly interested in talking to them about right now? What are the issues coming up that are particularly prevalent in those conversations you're having?
So to bring a real life example of a conversation we had just some hour ago, really, fact is expectations for economic growth, expectations for inflation, the central bank policy pathway, where are interest rates going, where will they settle, and where do they go beyond not just the next month or 2 months, but 2023, 24, even into 2025. Earnings of companies, how resilient are companies' balance sheets? We know at this point in time company balance sheets are stronger than what they have been in previous periods of slowing economic growth. But how does that stack up, and how do they continue providing capital back to shareholders, so keep paying dividends and remain solvent? And valuation is another example. I mentioned valuation, an important aspect when investing, when thinking about equities, but also fixed income, where across the teams there is more interest in terms of how they're valued relative to their own long-term history. So there's 4 or 5 examples. But whilst we're having conversations with our managers, Paul and the team are having their own conversations with the product providers which they work. So is there any examples from your side in addition? Or
in terms of where we're looking for opportunities, where we're focused on, it's very much within credit at the minute. So in bonds, you get corporate bonds, and the valuations and the yields on offer there are really attractive to us. You're getting a 6% yield on UK investment grade corporate bonds, so that's high quality bonds, which we believe is really attractive. When we look back at history, you'd have to go pre-GFC to get a similar level of yield. That yield, you're going to earn that naturally, and that's going to help generate a higher total return. So that's where we're focused on at the moment. I think in terms of just going back to the markets, at the minute looking forward, we've been in this environment, just and the volatility being caused by where interest rates are going. In the UK, expecting to go to around 4.5%. Similarly for the US, the market will start changing its focus onto corporate earnings. So we get Q3 earnings coming out this month, and we don't have a US central bank meeting till November. So all eyes will be, what are companies delivering? What are they saying about the future in terms of demand, in terms of labour markets, and that is what we need to start, what we'll be thinking about for next year.
And the great aspect about the seat which we're in the True Potential portfolios is we're not just, again, diversification, but in terms of resource and thought as well. Yeah. We're not just dependent upon one source of information and one analyst's view in terms of where interest rates are going, inflation's going, earnings are going. Yeah. We actually get that from each of our different managers who have research desks centrally within London, but also all around the world. So we'll speak with the teams in the US, across Europe, even access to teams in mainland China to get the on-the-ground expectations and analysis. Bring this all back together. So here, when we're making a decision for the portfolios and for our clients, it's a very well-informed view, which is from a range of different areas and expertise.
Yeah. Speak directly to our clients, Neil. Then you obviously through your job have a particular emphasis on dealing directly with clients through advisors and directly as well. What's your final message to clients who are watching this today who understandably might be looking at their portfolio and thinking, got some questions, we've had a few in, but they've listened to the guys, they understand, hopefully by the end of this podcast, got a better view of what diversification means. What's your message?
If you have any questions, speak to your advisor initially. Remain invested. You have a lot of people who, maybe thinking about not being invested and whether or not their money is better elsewhere. Categorically no, because it's really important to stay in the markets. And also we have a lot of clients who also want to put more money in turbulent times, because they realise they have a medium to long-term goal, and there's certain benefits to keeping their money invested. But initially I would say, if you have any questions, give us a call. We have nearly 50,000 clients now, direct, centrally, and we have a good team at Newcastle, the financial advisors who they can speak to, and regularly do. And
unlike lots of other companies, they're not sitting in their back room at home. They're here in the office. They're waiting.
They're head office based.
They can take your call.
Yeah.
They're not going to be interrupted by any other distractions
Call,
you might have.
Call. No, exactly. Call or video call. And we can do either with the technology.
Absolutely. And as you mentioned as well about the opportunity, if markets are down, that's a chance to buy the asset you were buying anyway, but buying it at a 5 or 6 or 7% discount effectively.
Yeah, exactly. Let's not forget what we're here for. We're here to generate long-term investment growth. We're here to manage the volatility along the way and position portfolios with what we believe are the best managers in the universe to help us achieve that.
Yeah. Well, look, I think it's been a good discussion, and hopefully it's addressed some of the questions that clients have sent in. They might have been wondering about what is diversification and how is it benefiting them. It's almost like a secret weapon that you don't quite see. It's there in the background helping all the time. You just maybe don't appreciate it. So hopefully we've explained a bit about what it is today. What's the most diverse thing you've done this week? George, come on. Or what's the most diverse thing you're going to do today? You're a diverse man. You like a bit of diversity, George? I know you do.
It's my second time in the studio today, so I've diversified my morning a bit by being in front of the camera. Most diverse thing I'm going to do today, let's have a think. I'm going to a spinning class. I've never really been to a spinning class, and I'm going to go to one tonight.
Oh, wow.
Yeah.
Lycra shorts?
Well, you never know, do you? Friday night, isn't it?
And we don't want to know either, George. Let's not go there. Paul, you like a bit of diversity. Maybe even the band.
Yeah, I can't think of anything.
Well, you need to work harder. You need to have a diverse weekend. Anyone got a suggestion for how Paul can diversify? There you go, Neil. Well, how can Paul diversify his weekend? What should he do? Put on. Well, he
could go to St James's Park and watch a proper football team.
Oh well, could do.
No, I don't know.
Is that your plan?
Yes, I have a ticket, so I'm going.
Yeah. How are you going to diversify that?
I'm
stretching the theme here a little bit. I can
not
feel
drink, because I felt as though I've drank my body weight over the last 10 days. So yeah, maybe stay off the beer. That would be diversification for me.
Good. Well, good luck with that. It won't happen, but I appreciate. I applaud the sentiment.
Can we ask the host?
Yeah, come on.
No. Right. Thank you very much for watching. We're just out of time, I'm afraid, George. Nobody wants to know what I get up to on a weekend. Thanks for watching. I hope that's been useful. I'm sure it has. And as Neil said, if you have any other questions, just pick up the phone, drop us an email, video chat, the full Monty. Just get in touch with us. We're here and we're happy to have a chat with you at any time. That's what we're here for, so take advantage of that. And don't forget, as I always say, hit that big red subscribe button, because if you do that, you'll see more of George, maybe even in his Lycra. You never know. Some people think that's an advantage, others don't, but hey. But he does morning markets. We're on the podcast. It's all there for you. It's on the YouTube channel, and if you hit the subscribe, you'll never miss it. That's the best advice. So for now, thanks very much for watching. We'll see you next time. Bye for now.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.